Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. My name's Seth Krussman, and I'm joined here once again by Ben Brayshaw and Dan Mickelin. How are you guys doing today?
I'm doing good. It's nice to have you back, Seth.
Yeah, it's good to be back. Thank you very much.
Happy New Year and happy return to the show. We missed you.
Well, Dan,
you did.
Don't go too far, Dan.
I did.
Yeah, come on, man. Well, we hope that you have missed us. If you haven't spent any time with us lately, welcome back. We're glad to have you aboard. If you're new to Money on Tap, this is where you want to be in 2023, and we're going to be talking about being the best you can be in 2023. How can you be the best investor possible? We love to take a look at all things surrounding, the financial picture, where you're at, bringing the industry to bear in you and your financial planning, and that three-dimensional investing perspective is what we talk about on Money on Tap. We're all financial planners with Brayshaw Financial Group. That's our background. Today, we're going to have try to lay out some very sound wisdom and advice for you going into this next year. And believe it or not, that's going to be some fun.
Yeah, I would say that there's a lot of questions of what 2023 is going to look like and the years to come. I think it's really not just about this year, but I think it's about positioning yourself for the next number of years, whether you're in retirement or, still looking forward to retirement. There's a lot of people in that space that are, kind of in between, right? There's different types of investors for each thing, and some people are fully invested and some people are maybe cash on the sidelines. And how do I look at this market? Things are down, but, I've been reading about this and it could get worse. And, how does that look? And what do I do? I think that's a big question on the minds of people that, I've chatted with. We've had some portfolios that have actually done really well. And this last year, we actually had portfolios that were up last year. So that was good and wonderful. It's hard to quantitate what you should do when it comes to moving in and out of stocks or bonds, or even treasuries, or something super conservative like CDs.
Yeah, there's some conflicting expectations, right? There's a couple of time-tested notions that seem to be at odds with each other that we're going to see how it plays out. But I'm specifically talking about, the 12 months following midterm elections. 19 out of 19 times it's been positive.
That's almost 80 years.
Yeah, 80 years, 100% track record. So
it's not just up; it's up 16.5 or 16.6% statistically.
Great statistical performance through that history. But on the other side of that coin, we have this impending recession we've been hearing about for a year. Every recession has led to a downturn in the market. Has that already been priced in? There's a little bit of unknown, and there's some precedent that you would otherwise think historically would give you a really good indicator as to how to behave as an investor. But something that's time tested is going to not pan out this year. So the question is, which way is it going to go?
Yeah, everything that everyone's talking about, there's a portion of the market that is either going to do what everyone says it's going to do, or it's going to do what the Fed says it's going to do.
Yeah.
I was reading something somewhere, I can't even remember where it was, but it was saying that of all the analysts, it was the most diversified a number of opinions of where the market was going to go over the next 12, 24, and 36 months. It was of all the analysts that they ever review, it was just the most diversified of opinions. And I think that's a quandary that a lot of people listening to this show and around the world that are saying, what do I do? Do I just get in and hold and hope for the best?
And I think for people who are not knowing which way to turn, one good thing that we do have, working for us as we move into the first half of the year anyway, is that there are some decent opportunities in real kind of safe haven places. Bonds are back. CDs look decent. You can actually get safe return, without having to take on the risk of the market, at least in a temporary fashion. So, there's always opportunities out there. And, I think as we get into the show, we'll take you through a few of the things that we're looking at to start 23 in the right direction.
Yeah, there's always an opportunity. There's always a flip side of the coin, and there's a ton of news out there right now. If you want to just turn on the TV and take a look, and that information is going to have an effect on you. It's going to have effect on your psyche. It's going to affect on your decision making, because believe it or not, you came to this planet pre-programmed with the strong desire to survive. and when you see multiple threats on the horizon, what do? You pull it in, you rein it in, and you hunker down. Well, you know what? That's great. That works in a lot of circumstances, especially when there's a bear at your door. But in the current landscape, there's a lot more going on that maybe you're not aware of, and we cannot wait to get into that with you here. And you guys just touched on so many, it's the show. It's going to be good. Before we go down that road, guess what? It is time for Money in the News.
And first up, we got an article here at the New York Post from Thomas Barbari. Elon Musk earns, and that's in quotations, Guinness World Record for the largest loss of personal fortune in history, which is, Musk is one of our favorite guys. I mean, we talk about him all the time. And, there's another quote in here that I think is just perfect for him as the CEO of a publicly traded company. Once again, he's great for those. But, usually when you aspire to get into the Guinness Book of World Records, it's for something as kind of more of a positive spin than taking the biggest personal loss of wealth in history. I
mean, his fortune, which reached a peak of $340 billion, he lost $210 billion. I mean, when you think about those numbers, to think that he lost $210 billion in basically a year. I mean, basically a year. It still leaves him as the second wealthiest man in the world, though.
This guy does nothing small. Like,
that's
everything is absolutely, it's just massive, whatever this guy's doing. It's just unbelievable. It really is.
Go big or go home, Elon.
Yeah. Go big or go bigger. And there he is. There's picture of Elon Musk right there. My gosh, that is incredible.
The person he beat, I was just thinking about this from a numbers perspective. The person who held this record before, it was the founder of SoftBank. But he lost $58 billion. Elon Musk almost lost 4 times that number. Like, he didn't just beat it; he beat it 4x.
I mean, this guy's literally taking his money and shooting it to the moon. I mean, he's just like, I don't need this. Here you go.
That was in 2000, and in today's inflation-adjusted numbers, I mean, maybe that makes more sense.
That's fair.
And the quote that I was talking about, Elon is just great with Twitter and the things he says, but he's apparently telling people at Tesla now, which is down 65% on the year, last year as a stock, he's telling his employees to ignore the stock market craziness. And it just goes back, it's a publicly traded company. Your obligation is to the shareholder. Don't ignore the noise. Make some money.
Yeah.
Please. Let's get some returns out of this thing.
I mean, they did sell more vehicles than they were up 40% in their sales. They just didn't hit the numbers that they were, So it's not like they're not selling and doing. I mean, they're moving cars. I mean, I see Teslas all over the place now.
No, they are. Yeah, they're
in New Hampshire
on the roads.
They're in New Hampshire and they're parked at a power station where they warm up. But sorry, that was a small dig.
He's made some big moves. The Twitter move was part of that. That loss, and it is interesting to take a look because a lot of people have talked about, well, beyond Elon, they've talked about Tesla is not a car company; it's a technology company, and there's that
a lot
out there, huh?
Yeah, you hear that a lot, and I appreciate that, but I think I don't know. I think that's, I don't know. I wouldn't.
Well, a year ago, Elon was telling you that the price of Tesla is ridiculous. Like, he's like, there's nothing to support the price that Tesla is at today. And this is, and we had that conversation. It's like, who says that to their shareholders, that this is completely overvalued?
Yeah, but a year before that, he was offering to take it private in a tweet. Another SEC, wonder there. But that was at what, $400 a share when it was trading at $300, or there was some disparity and was over the currently traded price. So even though he may have referenced it being inflated, and I know it spiked, in between those two statements, but he was still willing to buy it all back.
Well, I mean, when you think about, like, if it is a car company, like, so Seth, like, looking at the perspective of where you're saying, hey, it might be a technology company necessarily, as well as a car company, but when you look at like GM with a PE of 6, and you look at Tesla with a PE of 36, 6 times that, it's really hard to buy. Like, as Tesla settles into becoming more of a car company, it has to decline in value, which is what I think Musk was saying. Like, it's the PE, the price per earnings, is just way too high. The forecasting is way too high. We're doing great, we're growing, but I mean, from a standard, any other old car company, and you got to realize, like, the stock's down, 65% or something?
65, yeah.
So the PE was over twice that, right? So, I mean, at some point in time, you've got to say, hey, listen, this PE is way too high. And I think he's saying is, as this thing settles into a car company, he's agreeing it's not a technology company, is when he's saying it's too high. That's just my thought.
Well, eventually, I think the technology, water finds its level, right? I think that's really what's happening. And I got to give some credit to, one of my early mentors when I was just cutting my teeth in this industry. I brought him this company called Amazon, and he pulled me aside and put his arm around me and explained this concept or this terminology to me called a Wall Street darling. There's just not the numbers to support what the numbers are of the stock, and it's got a lot of fluff around it, and everybody loves it for all this reason. It was like $100 or something like that at the time, and I was like, yeah, you don't get it, and he didn't. And that was fine. But this would be one of those circumstances. Well, guess what? He got it, because that's what happened with Tesla. It was a Wall Street darling. It didn't have the financials to support the numbers. And that's all that Elon called out. I love it that he just really doesn't care in some ways. He's just above some of what everybody else would tell him he should say. Absolutely.
All right. Next up, we have... This article is by Matteo Sina. It's study claims wealthy blue state is America's most affordable, beating states thousands are moving to. I mean, this article is we should probably call this funny in the news, because as I read this article, I'm kind of embarrassed to even read it. But Wallet Hub released their 2023 analysis on the 2023's best and worst states to raise a family on Monday. The top 5 states were number 1 being Massachusetts, then Minnesota, New York, North Dakota, and Vermont. And as I said to Dan before the show, these are none of the states I'm going to raise my family in. Probably those are the top 5 I'm not moving to. I think it's funny because there's so many people moving out of it. Now, the top 5 worst states to raise your family in, starting with number 45, are Alabama, South Carolina, Louisiana, West Virginia, New Mexico, and Mississippi.
This what's really funny to me about that is that one of our good friends, Mike Woodall, giving you a shout out there, buddy, from college, I was talking to him this last year, and he moved from San Diego to South Carolina. I was actually in California, and I had about an hour and a half drive, and we filled that time with let's get caught up, and what he was so focused on was the quality of life that he was able to find in South Carolina, and he loved San Diego. And talk about quality of life. You're on the beach. It's beautiful. It's sunny. It's just amazing. But it really was the other factors of community and all these other pieces that he was talking about, that's what he was able to find in South Carolina. So subjective here, folks. You can find, first of all, you can find happiness and joy no matter where you're at. I would say joy. It's almost, it is a decision that you make when you get up in the morning. But with that, Wallet Hub definitely had some different perspective or some different lenses that they were adding to this for us.
Yeah, this is interesting. I mean, they were evaluating credit scores, mortgage debt, paid family leave, and median income, which is, so they were looking at like, hey, listen, these states, you make more money, and therefore even these costs are kind of subsidized by the fact that the average median income is higher. But the Missouri Economic Institute actually ranked Massachusetts as the 49th worst state for affordability, behind Hawaii and D.C. So it's kind of interesting how you've got. I mean, this is the only report I've listed any of these states to be the top of anything. So it's an interesting perspective.
Yeah, I mean, for sure, there's different ways to cook statistics, right? I mean, this is a prime example of it. I grew up in Massachusetts, and I think it's a good place to raise kids. I mean, but one thing I would never claim it to be is particularly affordable. I mean,
Yeah.
Housing is outrageous. Living and commuting downtown is really a problem. So, it's an interesting article. I don't know if I can agree with all the numbers, though.
Yeah, and I think you said, what did you say? New Hampshire was number 6.
New Hampshire came in number 6. Yeah, three New England states represented in the top 6, which is not bad.
Yeah, I just still blown away by the whole thing, to be honest with you.
Well, parts of those. I mean, it's hard to know where they're. I mean, if you were to take one of those topics and tease it out, you're right. You did it right there and said bottom of the list. Massachusetts is incredibly high, costly to live in. But there was so many other things there that was and you guys are very familiar with this as well. Joblessness is near non-existent in the Northeast at this time, right? It is really hard to just find, good quality people to fill, some typical positions that, are good positions, right? It's hard to find good people these days. So there's that, as well as some of the other things that were not really mentioned was the family fun. Visiting you guys over there, you guys know how to have fun. Every time I'm there, we're going to a ball game or we're going to museums and we're doing really cool stuff. I mean, I got to give it to you guys. You're really cool guys.
Appreciate that. Let's talk about some uncool guys here. Jana Herron's article, this is our last article here for Money in the News. Here's why the IRS would want to audit your taxes. Boy, we're really walking into the tax season. We've got a couple shows coming up I'm excited about to share. But the IRS is, they hired 82,000 new or 87,000, whatever it is, agents. Hopefully that gets completely repealed. I know they're working on that. But there's a lot of things out there that would really drive kind of a red flag warning for a lot of people who are filing their taxes. And this is what Jana has to talk about. So, one, too high of a deductions. Keeping your deductions within, in range. And make sure you keep your receipts for charitable deductions. High charitable contributions are something that are a big red flag for the IRS. And it's something that is not sent in by the charity to the IRS to affirm or confirm that you have donated that. So, like, for instance, in the opposite scenario, 1099s, W-2s, all of that stuff gets reported to the IRS. They can see that information and compare it. Charitable contributions are not. So if you if you are as generous and giving as you are, and you tithe regularly and things like that, believe it or not, it can be a red flag.
Yeah, the invoicing is critical. If it's meaningful enough to make that kind of a donation, the organization you donate to, understands and appreciates that they'll be able to document that for you. And, that's going to be a critical piece if you do fall into an audit. And, last year, the IRS audited 983,000 returns, which it seems like an astronomical amount, but it's really only 0.2% of tax filers. So, the odds are low, but a couple of these categories we'll kind of further get into are going to kind of increase your chances to get audited. And another one of those is foreign accounts. So the certain type of reporting that if you hold investment accounts and overseas, those notices do get sent to the IRS, and that's another factor in a little bit of heightened scrutiny for sure. So keep in mind that that's something that you feel free to engage in, obviously, but appreciate the fact that you're kind of moving yourself up the ladder in terms of a likely audit.
Well, sticking with that 0.2%, here's one even less, is 0.02% of those audits that took place, which was 17,000 of the 983,000 tax returns reviewed in 2021, came back with the IRS giving them more money and saying, you know what, you didn't do it right, and that's fine. Here you go. Here's some more money. So at least, it's not a 0%, but it's something.
Yeah, I mean, I think the thing is like you just got to be careful of like the little things. There's like little things that set off red flags the IRS looks for because it shows like you may not be taking the level of care that you need in your filing. Child-dependent write-offs, a big issue, like a husband and wife in divorce or whatever. One claims it and the other one claims it as well, and now you've got an issue. The IRS instantly sees that child's name because there's a Social Security number on the tax form with that kid's name. So you really have to be careful because something silly like that will instantly open you up for an audit. And it's, when in doubt, if your ex-spouse is not talking to you and they're going to claim it, it's like not worth claiming it yourself for the small deduction it could potentially be over the long cost of an audit and dealing with that. I also think it's interesting that most audits take place over the mail. So you're not going to get phone calls. So, from a kind of a get bad scam scheme kind of thing.
Wait a second. Is the IRS not at my door? Are they not on their way right now?
Right. And they're not going to call you, Seth, and say, we're on our way, or we need your Social Security number to confirm we're talking with you. Most audits take place over the mail, and the mail would then proceed to say that they're going to come and see you if they even had to. But most audits actually are completely done through the mail.
I got to figure out who I gave my banking and routing and account number to yesterday because I thought that that's what was happening. But you folks, just kidding. We're talking about best you can be in 2023. Be that better investor this year. It was a rough one in 2022, no doubt. So what can you do in 2023 besides just, hunker down and hide out and wish it went away? There's a ton, and we're going to get into it here. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Don't go anywhere. We'll be right back.
Ben, how often do we have somebody come into the office and they don't have a financial plan? And how critical is it for us to put the pieces together and make sure that their future, their retirement, is a successful experience? We talk about it all the time here at Money on Tap. If that's you, give us a call at 855-226-8551 or info@yourmoneyontap.com. Whether you have 100,000, 500,000, 5 million, look, folks, we have the right planner for you. Whether it's Ben or myself, Seth Krussman, we're here for you to get the plan together and make sure that that next step is right.
We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Are you the best you can be in 2023? Ben, Dan, I know you are. But if you're listening
I got room
today,
to grow. I got room to grow.
if you're here listening to Money on Tap today, the answer is yes. Why? Because you're engaging in your own success, your financial success. Just by being here listening today makes you one of the elite, and we thank you for being that for yourself. That's the topic for today. We're talking about being the best you can be in 2023, how to become a better investor. 2022, no doubt about it. I mean, look, from our perspective as financial planners at Brayshaw Financial Group, we were blessed, and our clients were blessed in 2022. There was no doubt about it. We just were so grateful for what God did for us in our businesses and in our clients' lives. Didn't mean that there weren't a lot of struggles. It just, for us, it was a really interesting period, and a lot of what we had talked about for years on our show here with you really came to fruition, and that's a really good feeling. So with that, we are going to start to lay out some principles and some ideas and some areas that you as an investor can really take a look at. And these are opportunities for you for this next 2023 year to be successful in your own investing. And if it's not with us, then with some other place, then we're grateful for you doing that too. If you're looking for more information of how to become more successful in your investing, you can reach out to us at 855-226-8551 or info@yourmoneyontap.com. And we'd love to offer you an introduction to Brayshaw Financial Group. And that's a free 1-hour planning session with Ben, Dan, and myself. And that's just part of the package here and what we love doing to help support our community at Brayshaw Financial Group and Money on Tap. With that, we're going to get going into the meat and potatoes, folks. What's it going to be in 2023?
There's a lot going on in 2023. The market is, roaring right now, which is kind of funny coming off of the year. And yet the Fed is talking about how they're just going to rates are going to continue to rise till the numbers that they feel are appropriate and relevant are in line. And that's that's a really scary place to be. I think the concern pieces that drive for me as I'm three-dimensionally thinking out is that, rates so quickly impact real estate at a level faster than any other industry there is out there, right? I mean, it's just like, and then on top of it, real estate and construction and the demand for construction and so forth, as the prices go up because of the rate increase, just from a simple home loan. Like if you're going to be paying, I think my house rate is like 3% or something like that. It's, crazy low. Like, we're going to move and buy a house and pay 8 or 10%. Like, just the cost to build or all of those things. People are going to borrow at these much higher rates, which makes everything more expensive, irrelevant if the price was the same pre-COVID as it is. You're still going to pay more just because of the mortgage. And that intuitively pushes people not to build, not to move, right? Real estate becomes stagnant. And, that affects the electrician, the plumber, the contractor. This is the blue collar workforce at its heart that drives America. And as they have less business, less work, all of that's less income, that's traveling less, that's all of those things. I mean, the outbound of their income is just going to decline as they decline in revenue and amount of business. So, this is like literally, I feel like it's almost a gut-wrenching to the heart of America piece out of anything.
I mean, forget about investing. I mean, just getting by, and I think that's more to your point. I mean, I just saw something this morning, that said nationally, on average, the cost of a dozen eggs has doubled in the last 6 months.
I would agree with that.
I mean, it's amazing to see, and it really brings us into just a very interesting time in the market and investing in general. So what we've done is taken a little time and kind of read through a bunch of information and all the various sources that we tap into, and we think we've identified a handful of opportunities for 2023 that may give you an opportunity to do a little bit better than just kind of passive index investing. One of the quotes I saw in getting prepared here that I thought was kind of interesting, and this is from an analyst somewhere, and you take all these things with a grain of salt, but I just thought this was well said. His expectation is less pain but no gain. And what he's talking about there is that the market overall may very well, end up at the end of 23 roughly where we're at now, but we won't have those, major index drops of another 20, 25% that we experienced in 2022.
Well, that's the hope.
Yeah.
I mean, I'm looking at some of the PE ratios and so forth, and I mean, with some of these cuts and what's going on, as interest rates go up, tech usually drops, and it continues to drop, and it continues to drop. And these PEs, I mean, there's less venture capital. There's less money out there to borrow for these tech companies to really unwind their thing. So, it's a conversation to be had. So I don't know that a drop is not feasible. I mean, we may break that 100% record of the last 19 midterm elections this year with, having a positive November to November crunch.
I mean, as we talked about in the open, one of these precedents is going to fail.
Yeah.
We just don't know which one, but one of them will.
Guys, it's going to be a glorious day here on Money on Tap when we do not bring up the Fed as a part of our conversation. And it's interesting, you hear just all sorts of commentary out there, and it's, the Fed's all over it. And what are they saying? What are they going to do? Clearly, they are bound and determined to bring the stock market lower. As a matter of fact, now they're looking across the board. They're like, well, all these other things we're bringing down, the CPI is coming down, which they're, predicting 6.6. If we hit that number, what do we, what does JP Morgan say the stock market's going to do, plus or minus? And we've seen some big swings in the last week, actually, in the big swings up in the market over the last week, just because of some of the positive information that we're getting. So what does that tell the Fed, right? They're going to go after it again and continue to do so until they pretty much get what they want. So I'm not going to try to fight that, right? How do we as investors fight something that we just have zero control over? We're going to go with it, right?
Yeah,
we're going to roll with that.
There's that whole piece of where the market's going. It's like it's really hard, it's really hard to buy an index right now because there's just certain parts of the world that are moving forward and other parts that aren't. So like if you're just buying the S&P 500 or you're just buying the triple Qs or you're buying any of these specific indexes, you could get hit hard. I mean, you could either be zero or negative, and yet there's a handful of companies that are going to rock it. And, I think that brings, the point of where, when you're actually picking investments, this is probably where, using people like us who are stockbrokers who can actually pick stocks, which is why we actually did really well in 2022 in our straight equity portfolio. I mean, we actually were able to pick stocks and we were able to actually design a portfolio specific to that scenario. So that was, I think, interesting because this type of environment is definitely, the stock picker friendly kind of environment.
And I think, if all this uncertainty about the, domestic equity market is leaving you feeling paralyzed or just unsure of which way to go, the good news is it's a big wide world out there. And that brings us kind of to our first point of where opportunity may lie, and that's in emerging markets, right? So we talk about the S&P 500, which is the 505 biggest U.S.-based companies. But, as I said, there's a wide world out there, and there's opportunity overseas that is going to be really driven by a couple of things that, leads to potential good returns for you this year, particularly the weaker dollar and the unwinding of all these supply chain issues that we ran into through the whole COVID and then immediately post-COVID experience. So their ability to export to the U.S. and drive profits for themselves from overseas is looking like a great opportunity this year.
Yeah, the China letting up on the reins of their COVID. I'm
zero COVID policy
mandate, right? Yeah. Anyways, that brought up a funny joke. I was like, gosh, I miss our mandates. Not really. The China letting up the reins on what they've been doing as far as their zero tolerance for COVID down there is really going to open up a whole new opportunity, a massive opportunity, as far as the expansion of their economy and ways to invest. And that's one of the primary ways that people are talking about right now. Of how do we take a look at the emerging markets, and that being really the one that makes the most sense because it has been the most suppressed and it is the largest out there.
Yeah, there's they talk about the middle class there. There's 250 million what they consider to be middle class consumers in China that are about to get unleashed for the first time in years. So there is just an expected spending wave coming, and that's the emerging markets and then China specifically is kind of a subset. Would be a really good potential investment opportunity. Take a look at some of their leading companies, whether they're doing business domestically or exporting globally, which most of them do to some degree. There's just massive economic might there about to get unleashed.
And as you kind of go through the China investment, and I hate the idea of investing in China. I mean, it just makes me
great. Isn't it really great that you can hate the idea of investing in China and still just knock it out of the park if you want to?
If you want to, I'm not probably going to be going there myself because, any sort of, change in their policy or standards, which is, there's no prediction of how they wake up on their side of the bed and decide what they're going to do tomorrow. There's a lot of buyer beware with China.
And that's the whole thing really around emerging markets and risk is it is a far more risky investment when you take a look at it. And in the current circumstances, that's one of the ways that people are looking towards gaining returns in 2023 versus the domestic market, which is cheaper, but still that price to earnings ratio that you're talking about is possibly more overpriced than what's available out there. So you buy your bananas, right? Of course, or what? I don't know. Can you buy U.S. based bananas anymore? Domestic bananas anymore? I don't know. I don't think so. But the point is, of course, you do your best to try to work with your neighbor here and support your neighbor. Then you go to the neighbor at the door down from there, and you go on and so on and so forth. But when you can take a look at the price differential, when you're buying bananas from your neighbor at $5 a dozen versus 25 cents a dozen from wherever they are overseas, that starts to make a difference, and people start to pay attention.
Yeah, and I think as you're looking at the China investment, and Dan, you mentioned there's lots of things about China opening up and separate from the emerging markets, but I was actually thinking about just the amount of oil and gas consumption. And I'm specifically speaking to natural gas, like that's gone up and then come back down. And, the demand that they have, which is what we export a ton of to them, is a huge, huge piece, which I think, we haven't seen anything. I mean, there's a pent up, think about the pent up demand we had coming out of COVID. And I don't know how many, is there 2 billion people in China? I don't know. I have no idea.
More than that.
Yeah. That's crazy, billions of people over there. So I don't know what the number is, but the United States is only 320 million Americans. Right?
Yeah.
I mean, we're talking like 6, 8 times, 10 times of the number of people coming out of lockdown.
I think, to your point about being hesitant to invest in China, there are a couple reasons to really take that to heart. Particularly their accounting methods are not the same as what American companies are.
As good as they are at math. As good.
Well, it's outcome based, so they like to work their math in interesting ways. But the fact of the matter is, separate from all that, and there is risk inherent in dealing with offshore companies that are just held to a different standard in their own markets. But when you look at one simple thing that just kind of guides me to tell that there's still opportunity. The trade imbalance is still massive. We import so much more than we export, and particularly in that U.S. to China scale, that in all likelihood there's just going to continue to be opportunity. They're going to continue to sell goods, and we're a consumer economy and they're a manufacturing economy. It just matches up.
Well, when you also think about the fact that we have started all of this chip manufacturing in the United States, or the encouragement of chip manufacturing in the United States, just the idea of China taking over or grabbing Singapore and dragging it into their
Taiwan,
or Taiwan. Yeah, I'm sorry. But that whole
hey, what are they doing? What are they doing now?
Yeah, no, Taiwan. I'm sorry, but I'm just when you're thinking about like all of that, there's just it's a loose cannon about China. That's really my point. Is there's a loose cannon about China that you just don't know what's going to happen and what's going to do, to the point where our government's literally making some intentional decisions that we need to quantify inside of our investing.
Yeah, I know Canada's already said that they're going to restrict Chinese nationals from buying property in Canada, and I think DeSantis is even trying that in Florida for residential property. So, politically speaking, they're not our friends.
No.
They have well expressed goals for global domination. So there's not a lot to like from that perspective. But if you're looking for short-term opportunity for return, it's something you really do have to consider. As portfolio managers as we are, that's the obligation, is to pursue return. But obviously, if anything were to happen with this whole Taiwan situation, all bets are off at that point.
Folks, you're listening to Money on Tap. We are getting ourselves into a moral dilemma here over China. And that cannon of almost 2 billion people has a big stick out there that they're getting ready to swing here again. So it's going to be interesting to see what happens. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about you and how you can be better in 2023. Be a better investor in 2023. That's what we're talking about here. Money on Tap. We'll be right back.
If you're listening today and, your questions are outside the box of estate planning or financial planning or any number of the pieces that we kind of traditionally talk about, don't forget that Brayshaw Financial offers auto, home, and business insurance. And we have an entire department that handles all of that for you. Give us a call at 855-226-8551 and be happy to take care of those needs for you. Or email us at info@yourmoneyontap.com.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, here's our Cliff Notes edition of Money on Tap.
SEC charges 8 social media influencers in a $100 million pump and dump scheme. It's basically where people out there own something, like own the stock, and then go out and promote the heck out of it, and everybody buys in and buys up the price of that stock, and then the backside of it, they're dropping their shares. And so what they've done is they've artificially enhanced or escalated the price of that stock so that they can be profitable. But most of the time, whoever's invested in that winds up losing, and there isn't transparency, and it is a crime. Apparently, we have some social media influencers, including Mr. Zach Morris. It's allegedly has been promoting certain stocks on Twitter and Discord and other places, promoting with 8 other people on podcasts and other places. And in the back of this, sold off their shares. And it's been a profit of approximately $100 million.
Words of wisdom. Don't take your investment advice from Mystic Mac, Laid Back, or the Stock Sniper. Those are probably not where you want to go.
Thanks for joining us for this Cliff Notes edition of Money on Tap, with great tips from the pros in three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. Now here's more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Folks, today we are talking about being the best you can be in 2023. And it's fun, right? We talk a lot about becoming a better investor. And there's all sorts of ways that you can do this in your life. You invest in yourself, you invest in your life, you invest in your family, you invest all the time. Right now, we're talking about 2023 and finances, and the landscape out there has really changed. I mean, it really has. I mean, if your mindset is still back in 2021 somewhere, folks, it's time to wake up a little bit and take a look, because the what's worked in the past is not working these days, and there's a lot more opportunities. Really, it was. Now take a look at 2020. When the market fell out and COVID happened, right? It was a tremendous time, a ton of fear happening. And of course, that's what the market pulled back and went into that deep V recession there briefly. But at that time, right, we did not have anything really out there in the fixed or the guaranteed world that was worth a darn at all. You were stuck, right? You were either going to cash or you were figuring out how to ride this baby out. It turned into being one of the best periods in our recent history in investments. However, today, folks, we have a lot more on the table that we can talk about in this world of fixed investments.
Yeah, I think about what we have been talking about for literally almost a decade, that bonds have been an anchor behind a portfolio. Like bonds have, it's like people would buy a 60-40 portfolio, and we created a 70-30 just to shed some of the bond kind of obligation to those standardized portfolios that so many people just fall into because they fill out a risk questionnaire. And then, so we actually started substituting, dividend growing stocks, high yield blue chip stocks in place of some of those to offset the drag that, the bond market was having with who wants to own Pfizer's bond paying 0.25% when you can own their stock paying almost 3%? I mean, it's like, the comparison of, company making trillions of dollars over a vaccine, irrelevant of the, debatable conversation of, whether you're for that or against that. It's still a return conversation, just like you said, Dan. I don't like China. I don't like investing in China. But the truth is that if we're talking about returns, comparing their bond versus their stock, the company's not going out of business. Not anytime soon, that's for sure.
One of the things, Ben, I think that's important, if you would please just highlight, because, I mean, we talk about 60-40, which is a 60% equity, 40% bond portfolio. It's based off of a risk paradigm and how much risk you can take and where you're at in your age and your timeline. It's just standard practice for financial planning. And it's worked historically. What you're talking about not only is a 70-30 portfolio, something that people talk about, but it's how we created that 70-30 portfolio. I think that was really critical to enhancing what we were really looking for, and also accomplishing the same goal that 60-40 portfolio is. I mean, not a lot of time here today, but just if you wouldn't mind talking about that briefly.
Yeah, no, I mean, the idea of, having 60% in kind of a stock-based portfolio and then 40% in a bond, portion of the holding, which, is usually bought through other, we're not buying specific bonds, we're buying ETFs usually that, are bond-based or, mutual fund-based, whatever that scenario is. And with the returns on those bonds so low and the fact that the rates were so low, as rates were projected to go up or expected to go up at some point, the bond values decline. And they're stuck collecting a lower yield than what's currently being offered. And so as we're comparing a bond from Pfizer paying 0.25% to the stock paying almost 3% at the time, and this is last year or whatever time, and it could be 0.5% bond at Pfizer. I don't even know. But the idea, the conversation here is that the bond's not going to grow in value because as rates were so low, it was just everyone knew rates were going to have to go up at some point in history, that you're just not going to, other than collecting a really low yield that you could get better in a stock, the company's selling trillions of dollars for the vaccine, whatever it is, it's going to push, it has better opportunity for growth.
And, even simpler than that, right? So that the 40% segment of that 60-40 portfolio, the bonds were, who cares what it is? It's a widget, right? But what it's supposed to do in the portfolio is maintain a stable price but spin off some income, right? And what happened in last year, and it had been going on over the last decade, is that maintenance of value wasn't really part of it, and the income it was spinning off was just subpar. It wasn't enough income.
It was so below what anyone needed. Yeah,
So what we did, and the opportunity that existed for us is, rather than buy the bond, there was alternatives that we could look at that would do that purpose, right? It would maintain a stable value, or so we hoped, and spin off income, right? So we looked at things like REITs and dividend-producing stock and other things that
were bond-like in feeling and thought, but not bonds by any means.
Right. And now, potentially bonds have come back into favor. And that's kind of the good news here is that, after a year in which, history would tell us when the stock market's up, the bond market's down, and there's this seesaw inverse effect. But last year, everything was just straight down, right? So there was no seesaw. It was just the ride to the bottom, no matter which side of the seesaw you were on. But going forward with the 10-year Treasury knocking on 4% a couple times in the last few months, I think it's like about 3.7 right now. That's real income. I mean, that's worth being in to stabilize a portfolio. And when 40% of your portfolio is getting, historically in the last couple of years, virtually no return, there's no reason to be there. But when you're looking at a 4% potential return, and if managed well, potentially a little higher, well, that's the kind of stability we're intended to have.
Well, you and I talked about even this morning. We were talking about the S&P holdings, where we went to cash back in April of last year in the S&P 500 holdings, and then from that point in time, we actually invested back in between 39 and 3,700. Got out around, I think, just shy of 4,000. Made a little bit of money, but meanwhile, we're sitting in treasuries when we're in and out, and we're sitting in treasuries right now. And I'm like, we were talking about well, we're going to get around 4% right now, so I'd rather collect that than just sit inside this whirlwind of uncertainty, because the Fed continues to say they're going to raise rates, and that's going to hamper the market. And I think, these kind of and the Fed even said that they don't even like these rallies.
Yeah.
Right? They said we hate these short-term rallies. We want to stifle these things. This is not healthy for our market. When did they decide what was healthy for the market? The market's a free market.
Ben, that's interesting. I did take a look at that. And there's many times that they historically have decided that they're going to step in and do some market manipulation.
And separate from the bond world, which has some, exposure to Fed activity going forward, so, you can lose value there. We do have an option in the annuity space that's actually offering 5.63% guaranteed for 3 years, which is really an incredible short-term rate.
Like a CD-based fixed annuity.
You're in, you're out, you earn that rate, really no risk to your principal.
Each year, 5.63 fixed for 3 years.
Guaranteed.
Done. Well, that's, there's a lot of opportunity in the fixed space that hasn't happened in a long time. And it's something that, I think Seth was making the point earlier, like, hey, listen, the government's manipulated everything. There's all these things going on. We've got some places to find some stable returns. I mean, for years and years, we talked to clients, let's try to get 5% out of your portfolio. And, that's kind of like the Monte Carlo history. And then Monte Carlo statistics drop down to like, you can take 3% out of your portfolio and never lose your, run out of money. And, but now we can get fixed rates again back at 5.63. It just makes the job of really providing income for people and for people in retirement to really have a better opportunity. So if you've built substance in your portfolio, some of these things might be able to ease the transition over these next 3 to 5 years, because we all agree the next 3 to 5 years there's a lot of questions. I talked about earlier on the show, there's so many opinions and they're so spread out about what's going to happen in the market over the next 3 to 5 years. It's really, really scary.
And I think that brings us into our next point for how to do your best in 2023, and that's to be picky. If you're going to invest in stocks, indexing is probably not the way, because there'll be so many laggards built into that you really want to be selective. And there are some opportunities that have come up. In the tech world, as interest rates rise, or if they continue to, tech is definitely sensitive to that. But there is a number of tech companies that are just global behemoths that have gotten absolutely crushed in the last year or so, that have to represent opportunity, both short and long term. Look at, and this isn't advice necessarily, but Meta or Facebook. That's got a PE down to 12. That was like the value of value stocks 2 years ago. Yeah. And that's what Facebook's at.
No, I never think of Zuckerberg or whatever as value anything.
No.
So, and I don't value any opinions of anybody at that company.
So I'm curious, Ben, would you rather invest in Facebook or China?
I think they're about the same.
Get that feeling.
I get that feeling too. I really like finding real hard substantive value. Like I like some brick and mortar right now. I think a lot of our listeners would probably like a little brick and mortar. I was talking to a guy the other day who was giving my name, and he said, I'm just tired of the stock market. What other options do I have? I said, there's a lot of options out there.
Yes, sir.
And Dan, you bring up a really good point. A fixed annuity like a CD. Even CDs, treasuries are paying 4%. There's just so much opportunity to find return that you do not need to step into the risk of the market. You should pick up the phone and call us if you're sick and tired of losing money, because there's options out there. There's lots and lots of options, not buying options, but other investment options. So that's where I think a lot of people need to look at.
Speaking of brick and mortar, infrastructure is really one of the final things that I think we wanted to discuss here today, which is, those places where that brick and mortar is happening. There's a lot of money right now being pumped into our economy through, infrastructure. Building out our infrastructure nationally here is a priority. With that, you can basically be in a defensive part of the marketplace with high yield, dividend, a lot of exposure into this sector with the 2022 Act of Inflation Reduction, basically some of the most significant climate legislation in U.S. history pushing this infrastructure part of the economy through. With that, folks, we hope that you've gathered some information for you to go out, do some research, take a look, see what's available. Where do you want to go? What do you feel good about? And also, get outside of your feelings, right? Get outside of that fear that's been knocking at your door this last year, telling you that, it's all going downhill. Because as you've heard today, there's a lot of opportunity. We're here to help, and we'd love an opportunity to talk to you about that. You can reach out to us at 855-226-8551 or info@yourmoneyontap.com. Make it the best that you can be in 2023. We look forward to spending more time with you here at Money on Tap and Brayshaw Financial Group. We'll talk to you soon, folks. Take care.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.
Well, bye.